Hey Bowtie Nation, Joseph Hogue here with the Let's Talk Money channel, and back today for probably the most requested topic on the channel, understanding the financial statements and how to do your own stock analysis. I'm excited to do this video. It's one you've been requesting for quite a while, and it's so important to what we're trying to do to put you in control of your financial future. And Nation, turn on CNBC or click over to any investing site, and you're going to hear dozens of stock picks in about at the time it takes you to say pump and dump scam. Now, it's not that the analysts you see on TV or online are all scammers, but most of the time they're going to own those shares they're recommending, so they've got a hidden agenda to make those stocks look as good as possible. And if they don't own the shares, then how much time did they really spend analyzing that stock? How much confidence does that strong buy recommendation give you if the analyst didn't think enough to buy it for their portfolio? Nation, every investor needs to know how to analyze their own stock picks. If you can't do that, if you don't want to spend the time to do that, don't even think about buying individual stocks. Just invest in those funds, because following analyst stock picks blindly makes you sheeple ready to be slaughtered in this market. So in this video, I'm going to give you those tools to analyze stocks. We'll go step by step to the basic financial analysts I use to pick stocks, the same process I used as an equity analyst for Wall Street and private clients. We'll cover all three financial statements, what to look for, and how to make sense of it all. First, though, I want to send a special shout out to everyone in the nation. Thank you for taking a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. So we're going to jump right into those financial statements and the stock analysis. And if you didn't see our first episode on how to read a stock quote, make sure you check that one out. I'll leave a link in the video description below, and don't miss our next episode where I'll reveal the 10 financial ratios that every investor needs to know. To start, there are 3 financial reports that you need to know about here. So we'll look at each of these, what they show you, and how to use them in your analysis. Now, these reports are released every 3 months to update investors on the company's quarterly results, and then each year in what's called a 10K annual report. Understand though, my goal here isn't to make you a Wall Street analyst. Okay, people study years to do that. Like, I spent more than 1,800 hours studying for the Chartered Financial Analyst exams. That's a CFA designation, besides all the other accounting and finance coursework that I've had. And what I want to do here though is give you the basics to make you a better investor. With what we'll cover today, you'll be able to do your own stock market analysis, your own analysis in stocks. You'll be able to give yourself kind of that second opinion when you hear someone talk about a stock pick on TV or online. And we'll start here with the income statement, and this is really the most popular among investors. It's the one you see most talked about because it gives you that breakdown from the revenue all the way to the bottom line earnings for the last 3 months or a year. Now, this is an important financial statement, and I'll show you some measures to use in your analysis, but it's going to surprise a lot of investors, a lot of you out there, that this isn't actually the most important of the 3 financial statements. You're analyzing a stock, and in fact, as a professional analyst, you're going to spend the majority of your time in that statement of cash flows, which we'll get into in a little bit. It's the cash flow statement that gives you a better look at that cash generating power of the business and just a purer look at how well the company is managed. But let's get back to that income statement, because there are some things here that you want to watch for in your analysis. Now, your income statement is going to show you total revenue, how much the company booked in sales over that period. Here we see Apple reported just over $260 billion in sales for all of 2019. Now, just under that is the cost of goods, or sometimes abbreviated the COGS, C-O-G-S. This is the cost of supplies and the materials that go into each product. So the first thing you can look for in this income statement is that trend in revenue. Is it moving higher or lower, and at what rate? And we see that revenue for Apple actually did fall by $5 billion in 2019 from the year before, but it's been trending higher over the last few years. We can also get a growth rate by dividing 1 year. So let's say the 2019 revenue of $260.17 billion by a previous year. So 2016 revenue here for $215 billion, and that's going to give us 1.2065. And since this is over a 3-year period, we take that by the exponential 0.33 to get a number for the annual growth, or 6.4% yearly growth in revenue. So a couple of quick points here. I know this is a lot of math to throw at you, but it's pretty basic stuff and absolutely critical to understanding the financials in a stock. So finding a growth rate is just going to be dividing 1 year's number by another and then getting an annualized rate, kind of like an average. The reason I like doing that annualized rate over 3 or 5 years is because it smooths over any 1-year hiccups at the company. Like we saw with Apple's income statement, if we were just going on last year's revenue growth, it actually is a negative 2%. So just using that would lead us to believe that Apple is all over. The next section on the income statement is going to show you those operating expenses and profit. These are the core expenses to run the company, like selling, general, and administrative, sometimes just abbreviated SG&A, and the costs for marketing. Towards the bottom here, you're going to see the operating profit, which is just the gross profit up from above minus all those operating costs. Again here, you want to look at that general trend in the operating costs and where they're coming from. For example, I can see that the costs for selling, general, and administrative have trended up from $14 billion in 2016 to over $18 billion last year. And where this really gets helpful is comparing the increase in costs to that increase in revenue. So if we get an annualized growth rate for those SG&A costs, same way we did for the revenue before, so taking the 2019 costs of $18.25 billion divided by the 2016 costs of $14.19 billion, we find that Apple's costs have increased at an 8.7% annual rate. So this would be a warning sign, right? And not only did Apple's revenue decrease over the last year, but over the last 3 years, its selling and administrative costs to run that business have been increased at an 8.7% annual rate, while sales have only increased at a 6.4% rate over that period. And what we can do with this, we would definitely want to compare these numbers with that of the competitors, like maybe Samsung or Sony. Are they also facing that same slow sales growth but increasing cost environment? Or is this just something Apple alone is struggling with, and why? Now, there's also going to be some important financial ratios here, but we're going to save those for the next video, those 10 financial ratios you need to use. So here, I want to just keep this on those important financial statement analysis that you can start with. And next we have the balance sheet, and this shows the assets, so what the company owns, the liabilities, everything it owes, and what's left over for investors. There is an important difference here between the balance sheet and those other two financial statements besides just what they measure. So it's also how they measure it. You see, the income statement measures all the business activity over the period, again, either 3 months or a year. So the statement of cash flows measures actual cash in and out of the business over that period as well. So every dollar in or out in every day of the quarter. The balance sheet, on the other hand, this is a snapshot. It shows you what you would see on the last day of that period if you added up all the company's assets, what it owes, and then what's left over for the investors. This isn't measuring the change in the assets during that year, but where they ended up. Now, that's important because it affects how we look at the balance sheet. Here, you always want to look at the most recent quarter. Okay, so the most recent reported, because it's going to show you the most updated numbers for these accounts. So we're here on Apple's balance sheet, and this always starts with cash and cash equivalents. This is the actual cash the company has, or very short-term investments that can be converted to cash very quickly. Here we see that Apple has spent down some cash over the last quarter, from having $107 billion in that first quarter to just $94 billion in this most recent, but it's been fairly stable over the last several quarters. Here you might not really need to find a growth rate. We'll be using this cash number later though in some calculations. The next section though, and this is something most investors totally ignore, but it can be priceless in finding problems with the company. This is going to look at the total inventories number and that trade or other receivables number. So inventories is just unshipped products. So if this is trending higher or has a big jump, does it mean that the company is having a hard time selling its products? Is it producing something that customers don't want and their warehouses are filling up? More important though is this trade and receivables number. Now, a lot of companies, when they get into trouble, or especially during a recession, they're going to sell more on credit. They'll ship out the product to customers and then give them 30 or 60 days or longer to pay. This is one of the biggest hints we see to a company in trouble, or those accounting shenanigans that management just likes to play to make the income statement look better. You have to watch this trend in receivables because it's such a common way to inflate those sales. And basically, management extends credit to its customers, even if they know that those customers likely aren't going to pay or end up paying all of what they owe just to book those sales. Further down on the balance sheet, you'll find those longer term assets like the property, plant, and equipment the company owns, as well as longer term investments. Now, these aren't quite as important as those current assets though, so we'll move on to our next section. Next are the liabilities, and just like assets, these are split between current liabilities, which are things that the company needs to pay within the next year, and those long-term liabilities that might stretch out for decades. This trade accounts payable is like the mere opposite of that receivables we looked at. So this is the materials and other stuff that the company has bought on credit and still needs to pay for. Now, you can look at this trend to see if the company is maybe struggling to pay its short-term creditors. These current liabilities, though, tend to be a small part of the company, so I usually just skip down to the non-current and this long-term debt. This line for long-term debt is easily one of the most important on the balance sheet, especially during any time of a recession or economic weakness. It's during these times that you really want to watch your stock picks to make sure that the debt isn't going to get them in trouble until the economy picks up. So you can look at the general trend in debt here, or you can use a couple of the ratios that we'll look at in our next video. You can compare cash on hand to how much debt the company has. So does cash pretty much cover the debt, or is the company buried under a mountain of liabilities? Now this last section, the shareholders' equity, really isn't used as much other than a few ratios. You'll use it in the return on equity as well as debt to equity ratios, so a measure of investor return and leverage, but the debt and the cash sections of the balance sheet are really much more important. This last statement, the statement of cash flows, is almost totally neglected by investors, but I gotta tell you, this is the single most important statement for analysts. The statement of cash flows shows you the actual cash in and out of a company over that period. Now, that's important because it cleans up some of those accounting tricks management likes to use on the income statement. Management can fudge the income numbers by giving out more credit to buyers or slow paying its bills. It can book sales early or even hide some of its cost on the balance sheet. But since the cash flow statement is actual cash in or out, you don't get those accounting tricks here and you see the pure picture of the business. Now, the statement of cash flows is broken into three sections: cash flow from operations, investing, and financing. We'll look at all three, but the first one here is probably the most important. The cash flow from operations is the pure cash generating power of the business. It starts with the number the company reported as net income on the income statement. Then it's going to adjust it for some of those non-cash accounting tricks companies like to use. Now understand when I say accounting tricks, okay, these aren't necessarily shenanigans or things that management is trying to get over on you. The biggest one here is just depreciation, right? So the amount the company takes off on its income to account for those used up assets, so like property, plant, and equipment. This number gets taken off the income statement as an expense, but it's not actual cash the company has to spend. It just kind of fudges what the business is really earning. So you'll have that income or loss reported, then all of these adjustments. And at the bottom here, it's going to show you the total cash flow from operating activities. So even if net income or earnings for a company is negative, you want it reporting positive operational cash flow, or the company might be seriously in trouble. We'll also use this part of the cash flow statement to look at one of the best analysis tools in our next video, comparing the growth rate in cash against the net income to find companies with real quality earnings. Now this next section, the cash flow from investing activities, shows the long-term investments and the spending the company is making to grow the business. This can include things like money spent on research and development of new products. It can be acquisitions of other companies, or the other side of that, selling segments of its existing business. Now, here you really want to look for those big uncharacteristic changes. Things like, did the company make a huge acquisition, which would mean I would want to look closely at that company it bought, how much it paid, and if I think management can really integrate it into the business for those higher returns, or did it just overpay for it? By the same token, you want to watch this for decreases as well. Did the company cut its research and development spending by a lot, and how is that going to affect product development and its competitive edge going forward? Is it selling off some of those segments of the business, and how is that going to affect future earnings? This third section here is the cash flow from financing, and this is going to include dividends paid, shares issued, and the change in cash from debt. Again, big changes and trends are what you're going to be looking for here. Is the company issuing a lot of debt or paying it off? Is cash spent paying the dividends increasing even as the company is borrowing more debt and the cash flow from operations is maybe decreasing? For example, that's what happened at IBM over the last decade and resulted in one of Warren Buffett's worst investments. And you could have seen it right here on the cash flow statement. Now, the cash flow statement is going to finish up by adding up these three sections to show you the change in cash over the period. And one thing I'm kind of surprised Morningstar isn't showing here on the statement, which is why we'll use Yahoo Finance next. This is what's called the free cash flow. So free cash flow is just a measure of additional cash the company is generating after paying costs to keep the business running. And you find this one by taking that operating cash flow, so the cash generated from that core part of the business, minus capital expenditures, which are found in that middle section, the cash flow from investing. So you've got actual cash collected by the company for running the business. Then this capital expenditures, or sometimes called investment in property, plant, and equipment. This is the spending that the company needs to do to replace that old equipment and basically just keep everything running smoothly. So taking that money that was spent to keep the business going from the cash generated from that core part of the business, this is going to give us what's called the free cash flow, or FCF. This is just a measure of the cash generated on an ongoing basis. Just like those other numbers, you want to follow the trend here and make sure that any stock you buy, the company is increasing its cash generating power. Click on the video to the right for the first in our stock analysis series, How to Read a Stock, and don't forget to subscribe so you don't miss our next one in those must-know financial ratios. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.